Welcome back to the M&A Transaction Service YouTube channel. My name's Patrick O'Connell, and I'm an M&A expert who's been conducting small to medium-sized businesses for over a decade. Today's topic is the 5 benefits of conducting a quality of earnings. I've been conducting quality of earnings for the past decade and have worked with hundreds of great clients. So I'd love to talk and dive into this very important topic. Let's roll. 1, it enhances an understanding of financial health, providing a deeper and more accurate understanding of a company's true earnings, cash flow, and overall financial health. If you're purchasing a business, this is critical. You want to know, A, is the company profitable? And more importantly, B, what does that profitability look like in the next 1, 3, or 5 years? 2, it improves the investment decisions, helping in identifying potential risks and opportunities that might not be apparent in the financial statements. 3, effective diligence in M&A helps acquirers understand the financial realities of a target company. During the process of whether or not you will buy a business in the financial due diligence, you will often conduct several inquiries with the owners and management to obtain an understanding of how the business makes profits through customers. What does that customer profile look like? And more importantly, what does the forward-looking outlook look like in the next 1 to 3 years? 4, it aids in the identification of non-recurring items that may distort a company's true financial performance. If you think about any business, there may be at times occasional instances of a one-time expense. For example, if the company owns a building and that building was severely damaged in, let's say, a fire, storm, etc., they may need to have out-of-pocket costs, which is out of the ordinary, to fix the damage. Let's say those costs were $50,000. The quality of earnings looks to normalize those costs. What does that mean? Normalizing revenue and expenses, you would basically remove those one-time revenues, and in this case, those one-time costs to fix those buildings, because in reality, it's not expected that you as a business owner would pay those costs every single year. On the flip side, if we think about one-time or non-recurring revenues, if the business had a customer who wanted to conduct a big conference that they normally didn't come with, it's the first time they conducted it, and the company had $100,000 because they helped set up the conference and facilitate it, those revenues, unless they were expected to continue year over year, would also be removed as you normalize the company's earnings. So again, a lot to unpack. Quality of earnings, normalizing revenue and costs, like those 2 examples we just spoke on. And the 5th objective is it increases the credibility to stakeholders and shareholders and investors when you conduct a quality of earnings. If you are looking for outside investments in order to support purchasing the business, often investors, and rightfully so, will want a third party to conduct the analysis, present the findings, and you as the buyer will present the report of the quality of earnings to the investors for them to review. This not only gives them a third party reliability of what does the business look like, more information, it also adds confidence if it's conducted by a professional such as a CPA, an acquisition advisor, or someone that's very experienced in this specific space. So again, those were the 5 benefits of conducting a quality of earnings. Stay tuned for the next episode.